Hello everyone, my name's Tim Hughes. I'm the Director of Communications for Spirit Invest. And today it's my great pleasure to talk to Marc Wiese, the Managing Director of Warwick Wealth. Today, Marc, we want to talk more about the range of investment offerings out there, the complexity of investment vehicles. And let's just go through what the choice our clients have, the sort of choice that they have, which has become increasingly wide and increasingly complex. There's been an evolution of the financial markets as well. So let's just talk about, if we can, please, some of the vehicles, some of the vehicles and the offerings that are out there, going right the way through unit trusts, share portfolios, etc. Over to you, Marc. Just take us through, if you like, the portfolio of offerings out there in the marketplace.
Thanks, Tim, and thank you very much for taking the time to watch this video. I think to start off, there are a lot of different investment options available to clients nowadays. And I can kind of summarize them into four main categories, although there are more. But I think the first one, and probably the most generally used category, is unit trusts, which are collective investment schemes. And effectively what a collective investment scheme is, pooling of clients' assets together in one investment vehicle. And there are several advantages to that, and like anything else in life, disadvantages as well. The second one would be a personal share portfolio, which could be either a local one or international one, where that portfolio buys individual stocks, which is held in your own personal capacity. The third one, which certainly is a vehicle available to a lot of clients, and in some instances makes a lot of sense, is a private equity type investment or fund. I think from a private equity point of view, it's certainly something that's taken a lot of spotlight in the past in positive and negative ways, and it's probably quite an important one to keep an eye on and get the right advice on. And the fourth one, which I think probably more recently with retail investment funds being more accessible now, is hedge funds, which once again, with all things out there, positives and negatives, but hedge funds are generally uncorrelated to the market and can certainly add alpha and additional returns to portfolios.
So that's the broad range of what's out there, Marc. For the investor or the client or anybody watching this video, just in summary, what are some of the essential advantages and possible disadvantages of each of those respective categories of investment vehicle, please?
Well, it's obviously a short video, so we've got limited time, but I'll touch on the main ones. We can probably sit and talk about this for quite some time. But as I've mentioned, a unit trust is a vehicle that pools clients' assets together. And I think probably one of the best advantages of a unit trust is the fact that it provides quite a lot of diversification. Whether you're investing 100,000 or 100 million, your portfolio is invested through several different local, international, or property or fixed income, or whichever asset classes. And because the assets are pooled, it provides a lot more diversification. From a negative point of view, I think it's less transparent. Although I think in today's world with MDDs or minimum disclosure documents as they're called, you've got the top holdings, you kind of understand the fees and the structures and how it works, track record. So I think we've come a long way in terms of the transparency within unit trusts. But ultimately, as these vehicles contain the proprietary research from the underlying asset manager, generally the information on there is fairly limited. You're not going to get a breakdown of everything that's owned in there. Next up, looking at share portfolios. I think share portfolios are great in the sense that they're transparent. You can see exactly which stocks are owned, they're owned in your own name. Yeah. Certainly a big negative around a share portfolio, and it could be argued as a positive as well, is every time a share is bought and sold, if it's a discretionary investment in your own name, you'll be triggering capital gains tax. Now, there's certainly also a theory out there that triggering some capital gains tax from time to time allows you to use your annual capital gains tax allowances, which could be a positive. And it's also quite transparent. You can see exactly what you own, you can see exactly what fees are being charged. Looking more at private equity. Now, private equity, I think a lot of people have made a lot of money, a lot of people have lost a lot of money, and generally it's not very transparent. I think one of the big concerns with private equity funds out there is, because it's not regulated in the same way as normal unit trusts, the theory around what type of risk the underlying assets hold is very subjective. Subjective based upon that manager and what they think is the underlying risk. And often I think there's a misperception on how risky some of the funds are. But I think there's certainly a space for it, and a lot of people have made a lot of money and add a lot of additional returns to their portfolios. And then the last one is hedge funds.
Yeah.
I think there's a perception out there around hedge funds being fairly expensive, which is probably quite true. But the advantage of hedge funds generally is that they charge a performance fee. And if they don't outperform their benchmark, which is generally the market or whatever they're comparing themselves against, they don't charge performance fees. And I think that, looking at hedge funds, finding the right hedge fund that's got a good long-term track record, that doesn't take excessive risk, where the managers understand when to get out. You can generally see that if a hedge fund's got a long track record, has generally outperformed, adding that within your portfolio, although it's quite volatile, could add a lot of value.
That's excellent. Well, but we know that we're talking to private clients now. So in conclusion, what sort of advice would you have for private clients? Because this choice can be a little bit perplexing, I suppose. So what's your key message to investors or private client investors who are looking at this range of investment vehicles?
Well, I think the investment industry has become exceptionally complicated with all these different products, all these different asset managers, all these different asset locations. And I think it's probably hasn't been as important as it is today and going forward to have someone with you on that road, unless you are a specialist and experienced individual yourself that's very keen on the financial markets, knows how the market operates. My suggestion to most clients or private clients out there would be to partner with a financial advisor, someone who's qualified, experienced, well-regulated, has been around the block. Often these individuals are also partnered with discretionary fund management businesses who are generally focused upon the asset allocation side and how to structure portfolios. And to have someone with you on that road to see how these funds are correlated, what is the real risk and the standard deviations associated with the underlying investment. It's probably more important today than it's been ever.
Thanks, Marc. So how people watching the video, how do they get hold of Warwick? What are the contact details of Warwick if they're looking for financial advice across this range of instruments?
I think at Warwick, first of all, our advisors are qualified and experienced and regulated. We also partnered with one of the top DFM and asset management groups in this country called Orion Investment Managers. And there's a lot of training, a lot of discussions, and a lot of support from the different asset managers into how the portfolios are structured. So feel free to reach us on 0800 50 50 50 or email clientcare@warwickwealth.com, and we'd love to meet with you.
Excellent. Thank you, Marc. Until next time, stay invested. Thank you.
Thank you.